Okay, so I think it's recording, yeah. So, tell me, so this is revaluations. Tell me the question.
When you buy it, the first day you buy it is 500k.
Now it's land, right? So there's no depreciation.
No.
Okay, so it starts with 500k, yep.
And then first year, it's revalued to 520k.
End of the first year? Yeah, I guess so. Yep, 520.
In year 2, the company revalued it to 500k.
Okay.
In year 3, the company revalued it to 480k.
Okay.
And then year 4, company revalued it to 510k.
Oh shit, I didn't have enough room for that. Okay. So the idea with revaluations is we don't treat upwards revaluations the same as downwards because we're conservative, right? So conservative means don't record profit unless you're really sure. Don't record assets unless you're really sure. In this case, we're talking about profit. But if there's a possibility you went down, record a loss. So we're more likely to record losses than we are to record gains. Okay. So in the first year, because there's no depreciation, it makes it easy because what you have to keep track of.
We'll talk about depreciation later.
Yeah. Okay. All right. So let's talk about basic land. So in the first year, it went to from 500 to 520.
So when you buy the land,
debit land, credit cash.
Credit cash.
Yeah. Okay. So that's debit land, credit cash. Right. And then after 1 year, you're revaluing it upwards from 500 to 520. So that's an upwards increment of 20. Well, it's an increment of 20, right?
Increment.
Well, yeah, increment means an increase.
And how about the other one?
Decrement, yeah.
Not decrement.
Doesn't matter how you pronounce it.
Decrement.
Decrement. Who cares? Excrement.
The guy from Norway says decrement.
Oh, who cares?
Okay.
Okay. So you go from 5 to 520. So because you're going up, you are increasing the asset. So you debit land 20, right? But because it's an increase...
No, but the land is 520.
Yeah, but you've already got the 500 recorded when you bought it.
But how about in the balance sheet?
It's got 500. It doesn't disappear as soon as you buy it. The 500's still there.
Yeah, I know. So year 1, you record the debit land. So in the balance sheet in year 1,
well, that had the 500.
Debit 500, land 500 and plus 20.
Well, you had the 500 in that journal entry. Right, journal entries are just changes, right?
Yeah.
So that made the land go from 0 to 500.
Yeah.
And now you revalue it by 20, so the balance is now going to be 520.
So in the balance sheet, it's 520.
Yeah.
Oh, okay.
Right. So you debit land to increase it from 500 to 520, but your credit cannot go to profit because of conservatism. So you put the credit to revaluation surplus for 20.
What is revaluation reserve?
Okay, firstly, that answer's wrong. Revaluation, there's no such thing as revaluation reserve. That's the old name for it. It should be called revaluation surplus.
Oh, it is.
Yeah, okay. But yeah, it's the old name. Unfortunately, when you get textbooks written by people who don't understand accounting, sorry, I shouldn't say that. Anyway, it's called revaluation surplus. It's an equity account.
But how come when we do the trust thing, right?
Yep.
We have revaluation as well. For example, this year, this one, it actually goes to the income statement. No, goes to the comprehensive income statement, and this one item called revaluation something, which is like in the. You remember the statement of change?
Yeah, but think about how it works when. All of your realized gains and losses, so all your revenues and expenses,
and eventually go to the equity, right?
Yeah.
How come when you record it to the journal entry, it goes to the revaluation reserve? It should like this year it go to this.
No. Wait, the statement of comprehensive income shows you these changes, shows you changes in reserves. Listen.
Okay, you tell me the nature of the revaluation reserve.
Equity.
So that's why I don't understand.
It goes straight to equity. All the statement of comprehensive income is, the other comprehensive income part, is a statement of what equity accounts have changed. So what you do, because there aren't many of them, you don't keep the changes separate from the account. Right?
How about the realized gains and losses for foreign exchange?
Yeah, but realized ones go through profit. They're called gain on loss, gain on whatever.
Yeah, this is called
unrealized. This is not. It's not. Yeah, unrealized ones don't. Because the point is, the reason you keep, like when you make a profit, Do you record it straight into retained earnings, or do you record it into revenue and expense
If
accounts?
it's an operating profit, it goes to the P&L.
Yeah, it's revenues and expenses, right? But why do we do that? We do that because profit has a lot of components and it's complicated.
Yeah.
So that's why we keep it change accounts.
Yeah.
Then we total them up, and then we put them to retained. Right.
Earnings, yeah.
The thing with these reserves is there aren't many of them, right? Reporting for these is not complicated. So you put them straight to the reserve, and then you put them straight to the reserve. That's it.
How come, like, when we do the P&L and the comprehensive P&L, and the next part, other than the operating part, the next part, and it has a realized gains and losses, unrealized gains and losses.
This still gets
this is unrealized.
It's an unrealized gain. It's an unrealized gain.
So this is like P&L. How come it goes to equity? Later on, it goes to equity.
It goes directly to equity, and all the statement of comprehensive income does is summarize the change in these equity accounts.
Yeah, everything changed, even the P&L.
The order doesn't matter, right? I mean, if you put something to profit, what you can do, if you want to do, is you can put all revenues and expenses straight into retained earnings.
Yeah.
Except that then summarising profit would be messy because it's made up of all these different items.
Yeah.
So what you do is you keep the changes separate. So you have one called sales revenue, one called cost of goods sold. Then you add them together, then you put them to retained earnings.
Okay.
So profit calculation is messy, right? These unrealised things aren't messy. There aren't many of them. So you stick them straight to the equity account, and then when you do your statement of comprehensive income, you just look at which equity accounts have changed, and you list them there.
So how come this one doesn't call it unrealized gains and losses instead of
It is an unrealised gain, but it goes straight to owner's equity.
Okay, well, it's different from what we did.
No, it's not.
It is.
No, it's not. It's only different because of the way you do it. The effect is not different.
The effect of
the effect is not different. And the point is, how you record stuff doesn't matter. The only thing that matters, this is a financial reporting subject. The only thing that matters is what ends up on the balance sheet, what ends up on the income statement, what ends up on the statement of comprehensive income. How you get there is a matter of how you design your internal accounting system.
Yeah, but the loss on revaluation.
Hang on, we're talking about gain first.
Okay, the gain on revaluation, right? It's also go to the comprehensive ones. Just one is go to realized one.
You're not listening. Look, I've
to
explained you, and you're asking the same again. Are you just going to keep asking again?
Well, you answer the same thing.
Because you have to know, it just goes straight to equity. It just forget all your State Street Trust accounting stuff. A revaluation increment goes straight to an equity account called revaluation surplus.
How about the realized one? Does it go?
No, realised one isn't called revaluation surplus. A realised one is called a gain on sale. So that goes to profit like everything else.
It goes to the revenue and the expense.
Yeah, well, how do you realise it? By selling it. So you've got a gain on sale of asset.
I thought the realized one go to the comprehensive, the second part as
No,
well.
no. If it's realised, it goes to profit.
Oh, well, it's different then.
Yeah, because you were doing some weird Jersey accounting rules.
Oh, okay, that's
Right.
why. Okay.
Well, it's not why. It's because
So you mean sales one go to the operating part?
always.
But the thing is, okay, alright.
What the thing is, what
No, it's okay. No, it's no
you're
problem.
You're overthinking it. Basically, with land, the increase goes to equity. That's it. Full stop.
Okay.
Right. Okay, so that goes to
Increase go to the equity. But how about the gain? Gain is the increase as well.
a gain is not a name of an account. It's just a description at the moment.
Okay.
This is an unrealised gain. It goes to equity.
Okay. If it's unrealized, it goes to equity. If it's realized, it
Well,
goes
except if it
to...
reverses, but we haven't got onto reversing it yet.
Okay, alright, cool.
Okay.
Yeah.
Come on, we did this stuff in 611. All right.
I don't remember it all.
So the land is now 520, right? In the next year, it goes from 520 to 500. So it's a downwards revaluation, so it's a decrement. So credit land, 20. Right? Now the other thing you need to know about, the basic rules for revaluations. Upward goes to equity. Downwards goes to loss and revaluation, which is part of profit.
upwards go to the
upwards goes to revaluation surplus. Downwards goes to loss on revaluation.
Yeah.
Except if they're being reversed. So if they're being reversed, they have to go to the same place they went before.
Okay.
So what happens here? You revalued in the first year from 500 to 520. In the second year, you're revaluing from 520 to 500. So that downwards is a reversal of the upwards. So it's got to go to the same place. So debit revaluation surplus for 20. Okay? Okay. Right. Now, in the next, so the land is now 500. Right. Now, in the next year, you're going to 480. So you're going down by 20. So credit land by 20. Right. Is this a new revaluation or a reversal?
New.
Right. So the basic rule is if it's downwards, it goes to loss on revaluations.
Nice, yeah.
Right.
Okay.
Now all you've done here is you've said, okay, loss on revaluation is like an expense account, so it's part of profit. Revaluation surplus is an equity account, but at the end of the year, you pick up all the changes in the equity accounts and you report them on the statement of comprehensive income.
Okay.
If you wanted to, you could have created, and this is what you were talking about before, if you wanted to, you could have created an account called gain on revaluation, unrealised gain on revaluation. And then you could have reported it in the statement of comprehensive income, and then you would close it off to revaluation surplus.
Yeah.
But the point is, there's only one on gain on revaluation. It's too much effort. Why create the account and then close it off? It's too much work because there's not many. Yeah, so put it straight in, and then that, because the reason you have accounts like revenues and expenses is because it's really hard to look through retained earnings and pick up all the sales revenues and all the cost of goods sold. So you record them separately to make it easy to do your income statement. Because there's not many of these things, there's not many of the unrealised ones, you don't record them into a temporary account. You put them straight into the reserve because it's easy to pick them up. Because each one might have 3 or 4 changes. Say, okay, there's the changes, I'll record those. There's the changes, I'll record those. Okay. So it doesn't matter how you do it. The way we teach it is straight to equity. Maybe we should change the way we're teaching it, but people don't want to change. But the effect is still the same. Because if you stick it into an unrealised gain, that unrealised gain will be recorded on the statement of comprehensive income, and it'll still end up in revaluation surplus.
Okay. What if here it's 520, right? The year 3, it goes to 480.
Okay, if it went to 480, sorry, end of year 2.
Yeah.
Okay, well, if it was doing that,
it was if it is 529, it's 480.
Okay, so what you would have is the land is 520. So 520. Yeah. You want to take it down to 480.
Yeah.
But its historical cost was 500, right?
Yeah.
So the first 20 is a reversal, so it would go to revaluation surplus.
Okay.
And the next 20 is new, so it would go to loss on revaluation.
Okay.
Right. So you always apply that rule. Upwards to revaluation surplus and downwards to loss on revaluations.
So
except the
should we
reversal.
credit the land 40, debit loss 20, and
debit revaluation surplus.
Revaluation surplus 20.
Yep.
Okay.
Yeah. Now let me just check the standard. That's the problem when you get people who don't teach this stuff writing textbooks. No offense to Liz and Ken, but looking at the auditing one.
Where did you get the coffee from? Downstairs?
It's hot chocolate, not coffee. You don't even know what you're drinking.
Okay, fine. Where did you get the hot chocolate?
Yeah, downstairs from the girls downstairs. Is it good?
It's very good.
That's nice, yeah. Okay, revaluation. Sorry, this is a quiet bit of tape. Yeah. The standard, AASB 116, paragraph 39, says that it has to be called revaluation surplus. It's not revaluation reserve. Revaluation reserve is wrong.
Well, I can't teach them that.
No, look, textbooks sometimes get it wrong, and students need to know that sometimes the textbook's not right.
Oh, I teach students that, and during exam they write revaluation surplus, and the Victoria, all the students write revaluation reserve.
Victoria will probably mark them both right.
Oh,
Okay, so what's your next question about revaluation?
okay.
Hang on, so this was the land?
Yeah,
I'll just stop this one.
part
Okay.
already.